Thank you very much. So, good afternoon, everyone. We are very happy that you managed to join this webinar today, which is actually the first of a kind, the first webinar we will be hosting. So, Capital Connect is a webinar organized by Kent Consulting and Events, created with a clear purpose to bring value to our growing community of investors and founders active across the GCC region. We are super proud to see how this community continues to grow and evolve, and especially how it has become beneficial for so many of you, whether through shared insights, the creation of meaningful connections, or even for new business opportunities. Next slide, please. Yep, so next slide, please, again. Thank you. So those of you who don't know Kent Consulting and Events, we are a UAE-based boutique economic development consulting firm specialized in supporting international trade and investment initiatives. Our cross-cultural, multilingual team has extensive experience working with prominent investment promotion agencies worldwide, including impactful collaborations on economic development and trade promotion projects. We are also the founders of the Gulf Investors and Founders Network, which many of you are part of, which is a platform that connects over 15,000 investors and entrepreneurs across the Gulf region. The platform fosters collaboration, investment, and innovation through pitches, partnerships, and targeted networking initiatives. I'm now handing over to my colleague and partner, Ian Barney, who is the COO of Kent Consulting and Events, who will lead this exciting conversation today. Thank you all.
So thank you, Zahra, and good afternoon, everyone, and thank you for joining us. I'd like to start by echoing the warm welcome extended by Zahra. It is truly a pleasure to have you all with us today. I would also like to welcome those of you who, as yet, are not part of the Gulf Investors and Founders community. We're so glad you've had the time to connect with us. We're living in an exciting time. The Gulf region is not only embracing innovation, but actively investing in it, opening the door to a whole new generation of entrepreneurs, investors, and ecosystem enablers. At the same time, we know that navigating the ecosystem can feel complex or even out of reach, especially if you're just getting started or new in the region. That's exactly why Capital Connect was launched, to make this space more open, more practical, and more connected by bridging the knowledge gap, one founder and one fund at a time. So thank you for being here with us. A special thank you to Thomas and Mark, who kindly made time in their busy schedules to share their valuable knowledge and experience with everyone here today. Before we begin the sessions, just a couple of quick housekeeping notes. Please make sure that you stay muted throughout the sessions to avoid any background noise and ensure a smooth experience for everyone. If you have any questions during the webinar, there will be an opportunity at the end of each session to ask questions. We kindly ask everyone to list the questions in the chat. Please add in the message who the question is addressed to. That will save confusion later on. There'll also be an open mic Q&A segment towards the end of the webinar for any further questions. Before we go any further, please note that this webinar is being recorded, and we'll be more than happy to share the recording with you in the coming days with all the questions that we've answered during the webinar, and any questions that we didn't manage to answer, we'll have the questions listed there and answers for you. Okay. Moving on to today's event, the webinar was designed to offer a dual perspective of the investor and the founder to help us better understand how capital and entrepreneurialism interact and shape the innovation ecosystem here in the GCC. With that, I'm pleased to introduce our first speaker, Thomas Como, Managing Partner at Open Equity. Thomas is a founder, operator, and private equity partner behind Open Equity, a growth stage investment firm backing founder-led companies to scale and exit successfully. With a track record that includes over $1 billion in the company valuations, more than $200 million in revenue scaled, and exit deals of up to $1.75 billion. He is now actively supporting Gulf-based entrepreneurs through both capital and conversation. He also hosts Open Equity Show, where he interviews top founders and investors and deal breakers from across the region. Thomas, the floor is yours.
Thank you very much, and thanks very much for that warm intro, and great to see so many faces on this. I hope that this can prove useful on your journey, whether you're just starting out, whether you're scaling, or of course, whether you're looking at as an investor looking to get into VC and PE and so on. So I'm going to walk through a few topics to give you a sense from an investor perspective, the lay of the land, and also an insight into how investment structures are set up. This was something when I was an entrepreneur and a founder first time, I had no idea about this, but it made a big difference once I understood it in terms of how to approach the right types of investors and kind of breaking apart what different investors look for and don't look for, which I think can help overcome some of the confusion or frustrations that maybe some people feel on their fundraising journey. We'll talk through what different investors look for, and then I'm going to walk through putting together a private market strategy or an investment strategy. Now, this will be useful for you whether you, if you are a founder too, because as I say, if you can understand what's going through the head of people investing, then you can kind of meet their needs just like you would customers. So next slide, please. So just to give an overview, I mean, as Ian alluded to, overall, what I see when I speak to large sovereign wealth fund investors and large institutional investors and government investors, over $1 trillion has been committed to the Gulf's transformation. A sizable chunk of that is in Saudi, but of course here in the UAE and beyond to Qatar and Bahrain and so on, there's an abundance of capital that's moving into tech-enabled AI sectors and the related ones in terms of infrastructure and healthcare and data centers and things like that. I was just in Riyadh for the last 2 days talking to a lot of large AI infrastructure and data center investors, and I can say there's an abundance of demand for folks in that space, and that ripple really means that then for companies building in the ecosystems, it means there's then an opportunity because investors are looking to get into to interesting and promising companies to help scale them up. There's also a lot of cross-border momentum. So when if I rewind maybe 5 years ago when I first stepped foot first in Saudi and then into the UAE, the GCC maybe was something that was extremely interesting to Gulf-based investors who would like to invest locally. But if I was in the US or if I was in the UK or Europe, it may not be top of their priorities in terms of whether to invest in the geography. That's completely changing. I was in there's a conference called Super Return, which is now I think in Europe, Asia, the US, and now in the Gulf. And there were thousands of investors there from large US firms who were desperate to get into the Gulf and desperate to find good managers, but also good entrepreneurs that they can back and scale. So I guess what's saying is, everyone here is right place, right time. There's also a lot of regulatory changes, which are making it more open and easier for folks to invest in the region. And of course, the more that it can become easy and attractive for you as entrepreneurs or you as investors to set up, the easier it is to then raise funds or deploy funds. The ADGM and DIFC now make it super easy to set up investment vehicles. You can there's lots of golden visas and all the things that you probably benefit from, and a lot of opening up of the private and public markets. Of course, too, many of the funds and firms that are setting up here, like myself, are backed ultimately by family offices and also institutions and sovereign wealth investors. And because there's such a concentration of capital in the region, which are looking to invest locally into the broader national missions, it's an exciting time. And I would definitely say and echo any points where people say, this is right place, right time to be. Next slide, please. So to give you a sense of, sorry, can we go back one? No, next one. Oh, actually, sorry, my mistake. Sorry, go back one. Yeah, I'm sorry, I apologize about that. My something that's really worth bearing in mind around fund structures, because I think I found when I was a first-time entrepreneur approaching investors, I thought that of investors just as a monolith of, you're an investor, you're interested in my company, and perhaps if they say, no, I'm not interested, then is it a personal thing? Is it personally they didn't think my pitch was good enough, or they didn't think our company was good enough, or whatever it may be? And it helped me a lot to understand how investment firms are set up, because they're set up in different ways, and the different ways in which they set up definitely impacts how they'll deploy money and capital and so on. And so there's a traditional fund model, which most funds, when you think of venture capital or private equity firms, they are set up in this way. They are technically called blind pool funds or closed funds. And this is essentially someone like myself. We will go out and we will raise money from investors, and we will typically say to investors, commit your money. And what we're going to do is we're going to deploy that money over a 2 to 3 year period. So we may start making investments, and then we're going to work with them, with these companies for maybe a 7-year period, typically plus or minus a couple of years as well. And the ambition is that we've pulled that capital, we've deployed it, we've invested in a portfolio of companies, and then we return it. And the compensation structure is that there's a management fee for managing that money, and then there's a percentage of the carry or profit. That's typically still the standard. There's over 11 trillion globally that's deployed across PE and VC funds. And I think why that's really relevant is because when people say I have a fund or we're deploying from a fund, that may or may not mean actually that they're actively in a position to invest, because it may be that they raised that fund several years ago, and so they're maybe having a conversation with you with a view to potentially raising a future fund, or it may be that they've just raised a fund, and that is therefore the best time to speak to them because then they're actively looking to deploy money. But in this traditional fund model, money is locked up, and it's locked up for a 10-year period, and with a promise that yields a return. The second model, which is much more common in the GCC right now, is a deal-by-deal model. This is much more flexible. It's often faster, and I think it's preferred because unlike the first model, where you essentially have to trust the manager that they're going to invest the money wisely across a lot of different things, and you may not know what exactly they are up front. In a deal-by-deal model, it will be just around one specific opportunity. So it may be your company, and it also means that maybe the terms can be a bit more flexible, because the manager or the investor that you're working with, the investors that are getting involved, and also yourself, you can perhaps shape that for the specific opportunity or the specific project that you're looking to invest in, rather than the traditional fund where they will try as much as possible to kind of standardize terms, just because it makes it administratively a lot easier. Now, there's a third model, which is this called an open fund or an evergreen fund, which is really growing in popularity now. And this is kind of a hybrid, or this was a reaction to a bit of both of those, where fund managers said, I kind of need the commitments that I would get on the first model to deploy across lots of different investments. But also the investors were saying, well, we don't really want to have our capital locked up maybe for 10 or 12 years. And so this was when a kind of an innovation was around evergreen structures, where rather than there being a fixed time horizon, folks will invest. You will then invest in many different companies with a view to then having some exits along the way, and the proceeds of those investors can choose to redeem those, or they can choose to invest or continue to grow. And those things are a bit more like a traditional holding company or some of the larger family offices have. And that's why it's typically favored by those, because they may be thinking across many generations rather than a 10-year period or a single company. Next one, please. Okay, and then to break down that a little bit further, because I appreciate that's it's quite a topic to understand. When you're approaching investors, I think it's really important to break out what different investors are looking for and what they are interested in. So you typically have three broad buckets. The first is angel investors. They'll typically get involved at the early stage. They're your first believers. They're the right people if you're just at the startup stage. It often helps if they have some expertise in a sector. They may be an exited founder in a similar space. And because it's normally their own capital, they can typically move faster, and you'll be talking to the decision maker. You'll loads of these, perhaps like we are here. There's lots of syndicates, there's lots of communities and networks where people share deals around. And I think this is a great, the more we can encourage this, the more that there's pull through across the whole ecosystem. And that then gets us into the second bucket, which is where you start to get into venture capital and private equity firms, where typically they'll be able to deploy a lot more capital. So at a VC stage, they'll normally get involved at kind of 1 to 20 million tickets, and at the PE stage, it's typically bigger, though these vary. And there are kind of growth stage firms like ours at Open Equity who kind of blend the two. But those folks are now not just deploying their own capital, they're deploying other folks' capital. And as a result, they need to think of it more in institutional decision-making around if I deploy this capital, what return can I promise to my investors, by when, and so on. So it starts to move from angel investors, where it's pretty loose and flexible and maybe an individual or a syndicate, to now into a more there's a bit more governance and decision making and processes and things like that. And I think this too, in isolation, I wish I'd known years before, because I would typically think I'm going to go and approach a load of venture capital firms to fund my startup or my idea, and will get rejected. And what I wish I'd known is actually the reason I'm getting rejected is just because they're not really set up to do this very early stage stuff. And then as we get down below, we get into the larger institutional and the sovereign wealth fund investors. Now, these folks rarely, if ever, will deploy capital against very early stage ideas. They normally want to come in, maybe there will be the series kind of C or beyond. But this is folks who are looking to deploy a lot of capital, and so they need companies that can actually take that on in a reasonable way. And it kind of makes sense that you would then invest in things with a long-term horizon around particular sectors that you think are going to have great tailwinds. And often with the sovereign wealth funds, they're very much aligned to the national interests. So PIF or Mubadala or ADQ, they will be interested in how they ultimately transform national economies. And as a result, that really shapes the scale at which they want to deploy capital, and also their mandate, as opposed to deploying into individual companies. Next one, please. Yeah, so what do investors look for? And this very much follows the previous piece, because ultimately, angel investors are really betting on the founder or founding team and betting on an idea. And a lot of that, in my experience, comes down to the team's strength and their personal chemistry. So, as an example, one company we're looking at now, the two founders have great experience in the space that they've started a company in. It makes sense. They have very complementary skill sets. One has the industry expertise and the other one is a very strong marketer. And often I'd then be investing as an angel investor in, have they got a really clear vision? Does it seem like the market wants what they want? Is there demand for the thing? And then from an investment perspective, does it look like actually there's potential to build a really big business? And typically as an angel investor, you'd be investing across a portfolio of different things. And so you're willing to take a much higher risk because you really need one or two to play out versus all of them. Then as we go into the PE VC firms, which is more where we play, we're already looking for traction. We're looking that actually this is scalable, and we're potentially looking that we see that there's a path to an exit, whether to a large competitor or whether to take it public or something along those lines. So it becomes less of perhaps more a feeling-based or emotional-based decision-making, within some grounding at the beginning stage, and now it becomes a bit more about the numbers and so on, because there's a bit more there. And then, of course, as we get up to the institutional piece, now some will invest on a direct basis to companies, but a lot of them will want to deploy, because they need to deploy quite a lot of capital. They'll want to invest in a sponsor or a general partner like myself, who then has a good setup, who can actually find great companies and can manage and govern those things. They'll obviously want to understand what are the ambitions of, if it is a direct investment at a company, but if it's a fund, what are the ambitions of that fund? So right now, there's obviously a lot of demand for golf-based AI focused funds. Same with energy transition or green energy projects, and likewise with infrastructure, whether that's kind of data centers or whether that's energy infrastructure or whether that's broader infrastructure. And they'll have big teams who are pouring through spreadsheets, who are looking at some of those more kind of investment banking and finance based things. But hopefully this gives you a sense of the kind of taking away from this monolith of investor, but really understanding what's going through the mind of folks as they're looking to deploy capital. Next one, please. Yeah, and so I thought it worth, whether you're sat here as a founder entrepreneur or as an investor, how to put together a private market strategy, because I think this is useful for whichever seat you're in. And I always advise, from a first point of view, is like I would do for myself, is the best thing is probably to just have, and I should say this is not investment advice, etc., but just to give you an idea of how I would think about the decision. You probably already have some capital that's in public markets that maybe is in just safe, easy index funds. But private markets are great because they give you potential for bigger returns, obviously, if you manage the risk and reward. And I would always advise, just like I would say to myself, though this is obviously not advice, build the strategy from your goals, income and liquidity needs. And so I often meet people who are thinking about getting into angel investing or venture capital or things like that, but they probably don't have the amount of capital that you would need to do it responsibly. Because the last thing you want to do is put all of your eggs in one basket, and then actually knowing that early stage companies are quite risky, and knowing as well that you may need to lock up that for a considerable period of time, which may not meet your own needs if you to cover lifestyle and other costs like that. From an investment perspective, this is really what I always focus on, is just investing in the inevitable. There are things that are obviously going to be much bigger in 10 years time, and really all you're thinking about is how can I invest some capital and then potentially some capability and expertise too into things that are obviously going to be true. So if we were sat here in 1994 or 1997 and you'd said we're going to invest into this internet thing, now some people would have thought that that's inevitable, other people would have thought that's crazy. But if you pull through that 30 years or so of digitalization, you know, it's obvious now in hindsight that there were going to be a lot of companies that were really successful. Probably the same is true now when we think about the next wave from digitalization to AI. Probably the same is true when we think about energy transitions from traditional energy to renewable energy. And probably the same is true when we think about all the demographic shifts in terms of an aging population and other things like that, which make healthcare and other things pretty interested. I always say, you know, get involved with companies that are positioned to win, where it's kind of inevitable. And this is the same advice I give to founders too, is you can choose to build any company, but I would always advise just reverse back from something that you think is inevitable. And as a result, it's going to be way, way easier because there's going to be demand in terms of capital. There's going to be demand from the market, from companies. And there's probably also talent too, who really wants to get involved in these things. And then the third thing, which I always think is kind of obvious, but is mistaken all the time, is just treating these as partnering with the right people. So working with fund managers or GPs or companies that give you more access to great opportunities, that have some kind of edge, that are actually, you know, different and better, and offer you something different than just kind of putting it into an index fund. Of course, you know, worth benchmarking based on track record and what do they actually do and what's their incentive structure. And super important is, of course, openness and transparency and proactive communications. You know, if you are looking to invest into anything, the last thing you want to do is to invest with folks where it's then very difficult to get information out of them, and they're not very open and things like that. So I think it's, you know, worth investing the time in getting to know folks if you are looking to get into private markets. And the same is true, of course, as a founder. I think it is definitely worth turning down capital from people where you have a question or whatever, because I know as a founder, you may think that money is going to solve your problem and suddenly everything's wonderful. I can tell you that if you get it wrong with the wrong partner, you may have just compounded all of that stress, because now you have a new boss who's screaming and shouting about why haven't you delivered X, Y, and Z that you promised to, and so on. So super important to make sure that you partner with the right people. You know, would you go for dinner with them? Would you like to spend time with them? Because you know, I've seen this go great, and you can build great partnerships, but I've also seen it go wrong, and it's quite difficult to unwind. So definitely worth doing your DD from every perspective. And I think with that, I believe that's everything from me. If we head to the next one. Yeah, so please do connect. The clue's in the name with us at Open Equity. You know, I, as a multi-time founder, I created Open Equity, and we then formed the company out of, I guess, frustration, but also belief that there was perhaps a better way to do things. I found with private equity, which I'd worked in before, I guess is the kind of slight play on words, is that it seemed very closed and it seemed very, I don't know, a bit elitist and difficult to break into. And you know, my thought was, after having some exits, is that actually could we create a firm that was the partner that I wish I'd had, and we can then provide, you know, not just access to capital, but also hands-on support and capability around the things that we think will make a difference to a journey. I should say that doesn't mean we invest in absolutely everything, because we'd be kind of flooded with stuff. But we are actively investing in growth stage companies in the Gulf with some traction, and we have good relationships with our family offices and institutions, and always looking to meet new companies, always looking to meet new potential co-investors, and also certainly open if folks are early in the journey and want a little bit of advice that can perhaps help them get investor ready or beyond. So please do connect. Very active on LinkedIn, and I look forward to having a good discussion and some questions.
Thank you very much, Thomas, for that comprehensive overview. So it's over to the floor now. Do we have any questions for Thomas? I think Zahra, you've got your hand up.
Yep. First question, I know that there's a lot of founders here, so I'm very pleased to hear that. So you've mentioned that you're open for partnerships and you know, you invest in startups. What are the sectors you're looking for? Because this is probably what's very important to some of the participants today.
Yeah, good question. So my background's building technology companies, normally working with governments and enterprises. So we like kind of B2B or business to government technology companies. That's obviously quite a broad range of things. We are currently looking at and investing. We have a data center and AI infrastructure business. We have a super app platform business that builds and manages things like Kareem or WeChat for businesses and governments. But we're generally interested in, you know, tech, AI, those kind of spaces, and cybersecurity as well as actually another one. But it tends to be those things. Normally, we're more interested in things marketing to governments or businesses as opposed to consumer things. Typically isn't something that we get involved in, just because we don't know that stuff very well.
Super, thank you. I'm sure you'll get a lot of interested parties. Thank you.
Thank you, Zahra. Do we have any other questions? Please raise your hand if you do have a question. So we've got a question from, Alfred.
Yes. Hi, Thomas. Thanks for that information download. My name is Alfred, and I'm the founder for Cloudscape Linen. I understand the interest lies keenly on the AI and government-backed projects on the technology front. What's your outlook on the consumer in the GCC and MENA? Like, do you have any sort of view outlook? Because there's a lot of consumer brands that's being built out of the Middle East in the last couple of years. And a lot of brands that's being built, but from an early, from an angel to a growth fund stage perspectives, there's not many funds in the region from what we've explored. We've been up and running for about a year and a half. There's not been any sort of strong partner to back up these brands. Would you be able to shed some light on it if you have?
Yeah, sure. That's a really good point. Yeah. And there is a reason for that, unfortunately, which is if we look at success of different asset classes, that tends to be really, most investors just follow the trend or follow the crowd. And so you may see lots of VC or PE firms talk about investing in disruptors and all of these things. To be honest, a lot of them actually just copy what other people do. And so the reason for there being way more B2B or government posting and less consumer is because overall, most of the massive success stories in the tech space tend to be enterprise or government. And I think the reason why, my experience actually being a founder, is it's way easier to build a B2B company than it is to a consumer company. Because with a B2B company, I can identify the 100, 200 companies that we want to market to, and can be very tailored about how I have a marketing strategy that does that. And with consumer, in my experience, you just have to raise loads of money to invest in mass marketing, and hope through investing a fortune that mass marketing is going to result. Now, because of that risk reward, that tends to mean there are more that are kind of are comfortable with the risk in the marketing to businesses, and less comfortable marketing to consumers. So that's not to say that you can't build great companies investing building that serve consumers. There are millions of examples of them. It's just that from an investor perspective, it's the risk reward profile is slightly different. And so being trend followers, there's more that focus here as a result rather than consumer things. And with consumer things, my advice would be probably go and approach exited founders who've worked in the consumers, who've operated in the consumer space, and they'll potentially have some capital, but also they may know the game and may help to then de-risk it, whether they bring in potential collaborators and so on. So that would be my kind of general advice, if that's useful.
Perfect. Yeah. Thank you so much. Thanks.
Thank you, Alfred. Mohammed, you've got your hand up.
Yeah, thank you so much. Great presentation, Thomas, very insightful. Probably I have two questions from my side. Now, I am a co-founder for a startup in the construction ecosystem, and we are very, very early in a sense. We are at pre-seed stage, so we are building the traction. So my question, the first question is, what would be the right forecast that we should give in terms of fundraising? In terms of runtime, we need to, when we ask for an amount of money, is it like for 2 years runtime or 3 years runtime? What would be the right formula or logic to take? And the second, you mentioned that when you pitch your startup, you should, I mean, investors are interested more into the future vision startups. Would that also backfire in a sense that they feel like this person is distracted instead of focusing on what he needs to drive right now, rather than thinking too much forward? If you can give me also your input.
Yeah, sure. I can probably answer actually. So I would say love big visions, and definitely would encourage people to be to have a broad vision, perhaps around the industry change or the potential to serve customers or businesses better, and what that can accomplish, and all of those things. But then in terms of funding, I always try to make it really, really grounded, and just say, well, how much capital do you need to achieve what? So I wouldn't say I wouldn't anchor it around a runway time. I would anchor it around some business milestones, and to say we need X amount of capital to achieve this much revenue, or we need X amount of capital to do these things. I would think it's a bit of a mistake if someone says, I want 2 years runway to do something. Then from my perspective, it's I don't know what that is, and we can't track and monitor it. So just like a project plan, I mean, this is effectively what investors investing in is a project plan. Is if you can say, I need this much capital to get to this milestone, and then this, and this, you'll find it a lot easier, because you may find as well, investors will say, well, I'm willing to give you a bit of capital, and if you hit those milestones, I can then unlock it faster. And that's a really good way of actually maybe getting a foot in the door or a relationship with an investor, is to say, I need a little bit of capital to get me to here, and then once I prove that you can bet on me, then we try and follow it through there, and that can be fine. You can then say that builds towards this massive end vision, but I would just try to ground it in reality as much as possible, and I can tend to tell. I think the first couple companies I did, I was very excited and enthusiastic and so on. And kind of as you get punched in the face a million times, you realize you get quite unemotional, and it's just kind of money to do things, basically. So I hope that's useful to supporting you.
Thank you, Thomas.
Okay.
Thank you very much, Mohammed. Mansi, you're next.
Yeah, hi. Thomas, this is Mansi here. Very good afternoon to you. Firstly, thank you very much for all the valuable insights. My question is that, are investors, or would investors be interested in a media tech opportunity in the GCC region?
Yeah, I would say I think investors are interested in anything, to be really honest. It's not so much whether it's a category or whatever. It would be more, I'd be looking at it and saying, if I invest this much money, how much potential can we get out of it? And so if you were to tell me media tech is exploding, it's growing very rapidly, there's an opportunity to get into that space and do something different. We've developed a unique proposition, the market really likes it, and now is the right time to raise some money to invest into achieving this, and this. For me, that's a very grounded investment case to get around. So it would be less whether the are there investors in X, Y, and Z. They're just investors around that are looking to get into different stages and different profiles of companies. And then the next thing is then that kind of grounding of how much capital to achieve to achieve what. So I would say yes, and the more you can kind of ground it in the specific investment case, the more successful you'll be.
No, thank you very much.
Welcome.
Thank you, Nancy. Okay, so Thomas, thank you so much for answering those questions. For the audience, if you have any more questions, please add them to the chat function, and we'll have an opportunity later for Thomas to answer any more questions. But now what I want to do is I want to move to our second speaker. I'm pleased to introduce Mark Reed, the founder and CEO of Estee, a serial entrepreneur and visionary leader. Mark is one of the co-founders of the first AI native platform for extended stays. With over 25 years of global experience across entities like Finnair, Trailfinders, Walt Disney, Mark has scaled up a startup from $0 to $2.1 million in revenue and built high-performing teams worldwide. He's a seasoned commercial strategist recognized for his inclusive leadership, sharp deal-making, and contributions to customer-driven growth and market expansions. At Estee, he's now reimagining flexible living through AI-powered dynamic pricing and seamlessly B2B, B2C integration, currently raising a $5 million funding round to fuel global expansion. So, Mark, thank you for joining us, and the mic is yours.
Thank you, Ian. Just to clarify, actually, we're on our pre-seed round, and we've raised $500,000 of our 1 million, just to put that bit straight. But other than that, so we're raising as well, so we're experiencing some of the founders' pain, as it were. We, as a team, we've been there before, so we do have experience, but it doesn't necessarily mean that you'll get it right every time. So the first thing I want to say to any founders on the call is keep banging your drum, keep trying, but also listen to the feedback you get, because too much sometimes you think you know everything and you don't, even in amongst your team. So you need to listen to the feedback you get from the marketplace, and if you're still convinced that you have all the answers and you're right and you don't need to correct anything, that's fine, but you may need to recraft your messaging and come across. So as Ian kindly introduced, so I'm Mark, and I'm the COO of Estee, and we're on our pre-seed round, as I say, and we're building an accommodation platform. So I'll drop into some of the conversation, how we try and cope with some of the situations we find ourselves in, and everything else. But first of all, I just want to say thank you to the team at Kent for having me. Thank you all for being here, and also to Thomas for a brilliant presentation. Really, really good. So really enjoyed the presentation, and also gave me some ideas that some of the things in my presentation is correct, and some of the things we still got to think about, which always keeps you on your toes. So if I can go to the next slide, please, Ian. So first of all, I just want to run you through just some ideas, basically. A lot of what I'm going to say today, I believe, is probably common sense, but maybe sometimes it's just a reminder that sometimes when you're immersed in something you really believe in, and like us founders, you're very passionate about what you do. Sometimes just conveying the right message or the value proposition can be quite challenging. And obviously, when you're speaking to investors, ultimately, they're interested in knowing what they're going to get from putting their money with you, or even investing time and energy, So this is the point. So first of all, we talk about when you're preparing for fundraising. So of course, first of all, you've got to have a compelling pitch, right? So that we might refer to the pitch deck, which I'll show you a classic structure shortly. We might refer to the pitch deck, but also you've got to tailor anything you're doing to the audience and to the time frame you've been given. So if you've only got 3 minutes to pitch your startup, or you've got an elevator pitch for 30 seconds, then you need to have all of those things ready. Included in that, you need obviously what your value proposition is, what your USP is, what your differentiation is, And what you're doing, you want to get someone excited by it, whether you've got the, like I say, the elevator pitch, or you've got some longer period of time to explain your proposition. There's lots of buzz at the moment in certain words and certain usages. You heard Ian mention AI. You know, we're using AI in our project, you know, to strengthen the customer experience, but also strengthen our business proposal. So this is really, really important. It's a current buzzword. Before it, a few years ago, Thomas will tell you, you know, there were other tech angles and things like that. Some are dead and some are thriving. So that's the thing. So time frame and audience, first of all, is very important. And then also when you're pitching, it might be the objective that you're trying to reach. Today we're talking about fundraising. So the objective here is obviously for you to showcase your proposition in a way that you're trying to achieve to raise funds. Okay, so that's the thing. So we'll run through a regular pitch deck in a minute, classic style, but your emphasis will be different depending on the time period you have, also the fundraising stage you're at, and whom you're speaking to. So the second one is your time outreach. No, sorry, still the same slide. Thanks, Ian. Time outreach and milestone and momentum. So basically, it was mentioned about runway. When you're a startup founder, it's very challenging. You need to know how much money you've got to last as long as you can last. Or if you're decided you need to raise money for your project, always be raising. Raising's a full-time job. So if ideally, and it's not possible quite often, is that you have one person senior in your C-suite, as it were, trying to raise money. It's like I say, full-time job. So don't delay it. Don't say next week and everything else. Just keep doing it, and you'll learn from every experience you do. Thomas mentioned milestones. Basically, milestones are really, really important. So for an investor to even consider putting money with you, they need to have certain milestones, and that could be something very, very simple in terms of achievement. So it could be sales achievement, it could be a development achievement, it could be an MVP. It's just something to prove your concept, prove something that works. And milestones can be staggered. They can be by time or by achievement. But if you get someone backing you early on, they often want to just, as Thomas even hinted to, they might put a little something with you, and then they just want to see what you do with it. You know, so if they like your idea, then that's important. Also have clear steps. So have an expansion plan. But don't go for immediate world domination, because what you've got to do, they've got to see a vision, but they've also got to see a realistic movement. So whether that's development on your product or service, or whether that's changing geographical region for whatever benefit, then either or. You've just got to show these steps so someone can see where you're taking it and see if it's aligned. Which brings us on to the next point. So the targeting smart capital that aligns with your stage. So in early stage, we're raising pre-seed at the moment. So friends and family are the most familiar. They're obviously the people that maybe put their money with you just for love, maybe. We haven't got any friends and family as in terms of this. We've got angel investment, and we've managed to secure a VC, which isn't always common in very early stage. So a lot of what you do, you need to align with the stage you're at and who you're targeting. There's no point, as was discussed, there's no point targeting VCs that don't invest, for example, in pre-seed companies. There's really no purpose early on, for example. Then you've also got angel networks, which are groups of people that take a collective risk analysis on what you're doing and what rewards you're potentially providing them. So with pooled funds, they're often good things to look at as well. And then later on, obviously, more later stage, you get maybe the VC, obviously onboarding. And also, but you can connect with VCs much earlier between stages as well, if someone's excited about what they see, and we'll come on to that as well. And then later stage, you've got the family offices, the CVCs, and the private equity. So just moving on, please, Ian. So this is a classic pitch deck structure. So obviously starting with the problem Yeah, so what is the problem? Is it just a problem to you, or is it a large problem? So you've got to make sure that with that, combining you with your solution, that you get across what your value proposition is, what your differentiation is, and then also very, very important for investors, the market opportunity is the size of the market. So the classic TAM, SAM, SOM, but if you can present it even in a creative way, again, be realistic, but also show a vision. Product demo maybe or is obvious, doesn't necessarily apply to everybody, but the business model is extremely important. So everyone wants to know how you're going to make money, even if you're not making money here and now. They need to know how you're going to make it and in what stages you're going to make it. Again, you've got to be realistic. Is someone going to pay for your product or service? A classic SaaS platform, for example, once you've passed the freemium stage, is someone going to pay for your product, and why would they do that? What alternatives are there, etc. So traction and metrics is a very good way for a potential investor just to evaluate what your potential is. If you're very early stage, as was touched upon again by Thomas, if you're very early stage, quite often a lot of will be to do with your knowledge of a market. It will be to do with the general hype or noise about the industry that you may be trying to raise money in, and it may be about your team, purely the team. The traction may be not so important, but you can get intent. You can show intent. So, for example, if you having serious discussions with someone, whether it's a B2B basis, for example, get MOUs from them, participate in RFPs, things like that. So unlike the classic metrics of LTV and CAC and such things, if you haven't all got that, you just present what you can. If you've got partnerships, present all your partnerships. Go-to-market strategy is vitally important to present that, how you're going to do things. You've got to be realistic. You're not necessarily going to put billboards for millions of dollars around Shakeside Road and hope for the best, because no one's going to invest in you. So you've got to be, your go-to-market strategy is really important. And the competitive landscape. So who else is in your landscape? Can you partner with them? Are they competition? Why are they competition? Why can you exclude them from your competition? How can you learn from what they've done right and what they've done wrong? So your team, and most important in early stage for sure. So why are you the best people to attack this proposition? What knowledges and skills do you have? And in the deeper team, if any, then you can present, people that believe in you. So even showcase, even if you're not giving them financial benefit or anything like that, showcase anyone that is supporting you that is credible, things like that. Financial forecasts are really just a little bit finger in the air. So this is a tricky one, especially if you are early stage. But obviously, again, it's got to be realistic in terms of financial forecasts and everything else. And it's okay to paint a picture and show ambition, but you've also got to be very realistic about what you can achieve with the resources you have. And that brings us on to use of funds. And what your ask is, whenever you pitch for anything, even if it's not for investment, you should always have an ask. So whether that's a number, put certain things to the number, why you need the funds, right? So for example, if you know you need to invest heavily in tech, and that's a high number for your ask of X hundreds of thousands or whatever, then you need to give a lot more substantial information about where the opportunity is, because people don't want it. People or investors don't want to put money into a tech platform when they're not convinced of the opportunity. So you've just got to swing that. If you say you're going to pay yourself a lot of money as a founder, then and things like that, why is all this money going? It's always going to my salary to sustain my lifestyle. Then no one's going to invest in you. Simple as that. So this is the point. And the vision and why now is just how is this a fad that you're asking people to invest in, or are you going to be around for a long time? Is there longevity in your idea and things like that? And obviously just keeping in touch, ways to contact you and so forth. So yeah, this is a summary. Obviously it can be much shorter, and it can be expanded in different areas depending where your strengths are. Next please, Ian. So what sort of lessons and what can you do? So storytelling is important, but actually just showing that an idea is credible is vitally important. So 60% of all startups originate from a personal experience, right? But the issue for investors is this opportunity or this problem that you had potentially, is it big enough to convince them that there's money to be made and that it's a real opportunity? So this is really key. So your storytelling should be up to a certain level where you can convey that to any investor. And again, relating that back to the type of investor you're speaking to, if you're talking to friends and family and they have money at their disposal, then obviously the storytelling may be not so important. But to an investor, they need to understand what the opportunity is. Okay. Be prepared to go through lots of due diligence. So have a well-structured data room. So, you have all your company details, have a very clean, if you can, keep your, especially early stage, keep your cap table very clean, because investors don't like complications. They don't want like, oh, well, we owe this money to this person, this happened, so we borrowed this. It's all very messy. It destroys the trust a bit that you're trying to build. If you can keep a clean cap table, and I'm speaking from experience here as well, if you can keep a clean cap table, it's very interesting, more interesting for investors as well, as long as you can keep that. Also have your knowledge about your vision about, so if your holding company is going to be in ATGM or in Delaware or whatever, have all this kind of thing, because it shows an investor you're aware of what structures are required. And also, now there's tools like AI to help you build ideas, at least for these kind of things, even if you haven't got a clue of how to build data room. You can do due diligence on investors as well. So we'll come on to that as well. So, but basically, negotiation is about alignment and not just valuation. You've got to give a realistic ask. Your value proposition's got to be there. And it's okay as long as you don't dilute too much in terms of your round. So just be aware of what you're asking for. So, Thomas hinted on it, that all money isn't good money. You've got to take the right money as well. So don't be desperate and just take money that's offered to you, as it were. You've got to be careful. And rule of thumb, I believe, and I might get corrected on this, is every round is like a maximum 20% dilution, because otherwise you get left with nothing. Next, please. So some early stage realities. What you want to do is gain feedback. So you want to gain feedback from potential users. Real users is obviously the ideal scenario. And if you can do that, you can show qualitative and quantitative, measurables. So any of those combination is amazing for investors, because they want to know that your product or service is sustainable if they put their money in. So real life user feedback is vitally important. So conversion rates, helps your retention, your engagement metrics, and things like that from measurables. And then from subjective things is like interviews and case studies, surveys, and forums and feedbacks and things like that. So anything that you can take on board. And it's, by the way, it's okay early stage as well to pivot or have intention to pivot. So pivot your idea, steer it more towards what the customer might want, whether that's B2B or B2C customers. But also don't do it on the basis of one or two people. Don't ever change your belief or your product or service based on one or two people. This kind of thing has got to be very obvious to everybody. So even if an investor says to you, I think you should do X, Y, and Z, it needs to be substantiated. Make sure. Focus on demand validation over polish. So what I mean by this is, it's okay to be raw. It doesn't matter. Investors are okay as long as if they can see a vision. It's okay that you can't do the best pitch deck in the world or whatever. If you can get your point across, even in a conversation, it's fine. And as long as they can see a vision and a scalability, that's more important than the polish. You can add the polish later. So you don't have to have a build an all singing, all dancing platform online if you can just build something that works. That's what I mean. You can make it nice later. So that's the point. Prioritize what's impactful under your resource constraints. So if you've got a small team, you've got to be careful with your time and energy and your money. So deploy your resources wisely. And what I mean by this is everything should have a KPI or an outcome attached to it, right? So for example, our KPIs or outcomes are anything that leads us to reach the investment stage or anything that leads us to a sale. They can be very simple, but anything that leads you to this next thing. Next stage, next slide, please. Okay, so there's some of the mistakes. So avoid overselling. Investors have seen it also. Excuse my language, but too much bullshit. They'll just see it straight away. You've really just got to be very clever and careful. So you've got to share your vision, and the risk potential attached to this and how you're going to get there. But don't oversell yourself, because it's great that you believe in something, but you've got to be realistic, because your industry probably better than they do quite often. But also you've got to make it believable to them. So if you're asking for money, you've got to say how it's going to help me. So how's it going to help me? Is it going to help my speed? Is it going to help my development? Is it going to give you a quicker return on your money? Is it going to help me with a market entry? Things like that. So just be transparent about, I need the money for X to get Y, right? So it's really, really important. If you can structure that really well, then people will be more willing to give you their money. Quite simple. So, and if something doesn't work, then change it. Yeah. So everything's got a risk attached to it. Experiment, test things. If you fail and fail again, it's fine, no problem. But do it quickly. Just keep changing. Yeah. Give it enough time, but don't keep your head in the sand that if something's not working. Yeah. So, because again, investors will spot this type of thing. Don't chase misaligned investors. So a lot of people waste time. We've done it as well. In the follow-ups and everything else. Keep in touch with people by all means, but if they really don't align with you, tell them what they're doing in an investment update, but don't keep pursuing them as such. Even if you're desperate, just create a pipeline. Ask around, ask fellow founders as well, who's investing. Is it someone you can introduce me to? Things like that. Always make your notes and just be aware of who's real and who's not. There's a lot in the region that don't do what they say they do and things like that. So just try and learn from those experiences, and know when to walk away from a deal. Just goes back to the point of basically. No, not all money is good money. So just be aware that you're trying to get from A to B, but ultimately you might want to get to C. So if by the time you get to Series D and you've lost most of your equity, it's really not that interesting from your side and from their side. So it can be very, very challenging. So just be careful that you structure something properly to get you from point A to point B. Next, please, Ian. Okay, so here is building trust and long-term relationships, especially in the GCC. You'll have conversations, and that's perfectly fine. Don't think of it as a waste of time. If you're speaking to what you believe to be the right people in the GCC market, for example, I was in Saudi recently. 2 meetings, having coffee, not really talking about the business or anything like that, or what the want is. You've got to gain sometimes trust. You've got to raise your profile. So what I mean by that is even silly things like I'm not too great on LinkedIn. I need to get better on LinkedIn. You've got to raise the profile of yourself, your company. You've got to take speaking opportunities. You've got to step out of your comfort zone, you may not be comfortable with. You've got to shout about your achievements as well. So any small win is an achievement, especially for an early stage startup. Shout about it. Get people in your network. Follow people on LinkedIn that you would like to be more engaged with and things like that, because they might notice one of your posts or they might link with you. It's rare now to say you want money and someone will just give it to you. You've got to justify the means, and as Thomas implied, timing sometimes is important. Also, if we're in a particular industry, And we know we've already worked out that that investor doesn't work in that industry, doesn't invest funds in that industry, or isn't deploying funds at the moment. Why are we wasting our time? But you can still keep a relationship, still keep a communication. Leverage accelerators and local networks. I'm a big believer in this, a bit like courtesy of Kent here, why I'm here. You know, they're part of my network, I'm part of the network. And also there's lots of people that want to help each other here. So we're actually based at In5, one of the government incubators, which is fantastic. Then obviously leveraging that to get accelerator programs and just get exposure. The more exposure you get, the more people that may be interested in you. The more people you speak to, classic example, or the more visible you are, the more interesting you become. So, you know, and accelerators are great for learnings. So you get mentorship, you can workshops, you can meet other co-founders, you can meet specialists in certain areas where you maybe don't have that knowledge, so you can learn from. So all of this kind of thing is really important. So tailor your pitch to cultural and market realities. So here, don't show something to someone that isn't relevant to them. So we were recently pitching in the US. To be very honest, we had to change our pitch deck up because most of our pitches are within the GCC. So if I'm showing something in the US just about GCC, it's less relevant to them straight away, so they may turn off. I don't mean realign all your schedule and your big plan and everything else, but just try and give them an idea of why it could work in their market. Yeah, so no one wants to be spoken to really on areas and geographies or things that they're not really aligned to. So it doesn't make any sense. So gear that pitch to make it as relevant as possible to where you are. Also on that basis as well, some nationalities, for example, or even some areas, their attention span is completely different. Their focus is completely different in certain parts of the pitch. Yeah, so, and again, we can help you with this if you want some ideas on this, because again, it's just from learnings. Next, please. And this is just my last slide, I think, guys. So sorry to keep you, but thanks for your time. So this one is just about choosing the right partners. So again, I allude to what Thomas said, which means that some of this aligns nicely with what he was saying. Sometimes with vision and the values proposition that you're presenting, if it doesn't align with the investment opportunity as well for them, then don't take it. You're within your rights to say no as well. You know, it's obviously a privileged position to be in. If numerous investors have an interest in you, so it's always very tempting to take money. But just if something doesn't feel right and your intuition says no, then follow it, walk away, and it'll be the right decision you've made. Otherwise, you'll just regret it. You maybe invest more time and energy in your thing, or someone will overtake and demand so much from you that it's not realistic. It's your baby. You know, you're in it maybe for the money or more. The investors are in it for the money. So you've just got to be aware that everything is aligned, and that's really important. Strategic partners offer more than capital. Yeah, I mean, later on, especially when you can, try and get someone that's engaged in your industry, for example, because if someone believes in it in your industry, it's very, very easy then to extend that beyond people and investors that aren't in your industry. So I think that's really, really important. Red flags on term sheets. I'm sure Thomas can probably speak better on this than me. I found a few red flags before, but obviously it's understanding who's remaining in control of your company at the time. It's you. As soon as you let other people in, it becomes quite difficult. You've got to justify yourself. You know, so you've got to make sure the control stays as long with you as possible. Until you get bigger, and obviously you have to relinquish more and more. So whatever round you're in, that will align accordingly. Share priorities and things like that, liquidation preferences, dilution clauses, and also as a founder, you're vesting and founder cliffs basically. So basically, if you walk away, or you have a co-founder walk away from your venture, it doesn't destroy the opportunity for you to raise capital. So that's really important, and obviously exit plan as well, things like that. So people want to see your longer term vision, even if you're not there yet. They still want to see it in terms of what you're trying to do by the end of it. So yeah, I think that kind of brings me to the end. So thanks for your time, everybody.
Thank you so much, Mark.
If you'd like to connect with me, this is my LinkedIn. And it'd be a pleasure. Happy to help if I can. And please connect. Also, some of my co-founders raised a lot of money in the past as well. So again, more than happy to share investor information and things like that, or just talk through with you what best strategy could be for you guys.
Thank you so much, Mark, for your valuable insights and the support that you've offered to everyone here. So we're going to start off with a few questions for you, Mark. Zahra is first in again, so up you go, Zahra.
Thank you, Ian. Mark, wonderful presentation. Thank you very much. I mean, your insights, this is worth gold. These are the questions that we hear from community members on a daily basis. So I think it was so nice to see that you've compiled it and put it into something very easy and easily understandable. One thing I'd like to add is that, in the region, and you've correctly mentioned that basically it's very important to tailor the pitch decks for the region. One thing I like to mention is that it's super important to nurture relationships, as you correctly said as well, in the region. Nurturing relationships is very important because a lot of the startups, especially the ones coming from overseas, we are in touch with on a daily basis. There's still the notion that, the moment we, land in the UAE or in Saudi Arabia, that the funds will be readily available. This is not the case. The competition is fierce. Even if you have a super, super exciting project, there's a lot of potential, but our advice is always basically to say that, spend some time, nurture your relationships, spend some time here, have someone on ground, come for a week or two, meet people, but nurture those relationships, or also have someone, a third party maybe on ground. But this is very important, and we see this on a daily basis. So yeah, just wanted to share this, but thank you so much again. Super insightful.
Thank you for the insights.
Pleasure.
Mohammed. So you're on mute, Mohammed.
Sorry. Yeah, do you hear me now? Yeah.
Yes.
Great presentation, Mark. Really nice detailed slides. And I'm lucky to have you around because I learned a lot from you throughout our exchanges. So I have I forgot my question actually. So I was going, yeah, here it comes. So one of the things that I get from my co-founders or startup entrepreneurs, they're wondering when we get into investor, how do we ensure that that investor don't have in its pipeline similar startups that close in terms of sector, and how we are sure that our solution, if we deep dive into more details, could not expose us to this portfolio already existing and inspire them. I know it's a weird question, but it's a valid one because
no, it's a good question, mate.
This question. Yeah.
No, it's a good question. So the truth of the matter is you can't. But if you know your industry well, you should know what competition sort of sits around the corner. So the thing is, if for example in the accommodation space I wasn't aware of certain accommodation platforms that exist or up and coming, then I wouldn't be in a good position to speak to an investor. Also now there's a lot of material out in the that who's raising, what they're raising, who they're raising from, and things like that. So speak to other co-founders like you do. I know you do, Mohammed. So speak to other co-founders and where they're having luck or where they're not having any luck. Speak to people. The misconception I think as well for any founder is that people in your industry are your competitors. Quite often these are strategic partners as well. So look at things as potential opportunity and make sure your USP is different to what the proposition is or what you're doing better. Take what they've got to understand what they're doing, what problem they're solving or how they're solving it, and see if you are competing with them directly. And if so, make sure you're just going to do it better And also, I'm not a big fan of NDAs. Again, Thomas may be able to elaborate on this, especially in early stage, right? There's very few things early stage, unless it's maybe deep tech, that are revolutionary, changing the world, the only one in the whole world. And if you say you are, I'd question it. Do you know what I mean? You might be doing something slightly different and play. So NDAs create a bit of traction, a bit of resistance with friction with the potential investors. I wouldn't bother, but hold back your secret sauce. That's what I've always been told. So hold something back, get someone interested, and then when you get deeper, it's more appealing. But don't be threatened by someone that's got an idea in your space. It really is. Just believe in what you're doing. Understand what they're doing, but don't be scared by it. Why wouldn't they invest if someone's looking to invest in another company in your space, right? Why don't you put yourself forward as well, right? And they'll invest in one or other more than likely, unless they're spreading the risk.
Thank you, Mark.
Pleasure.
Thank you, Mohammed. Any more questions from the audience? Okay, sorry, Nicole.
Mark, thank you so much for your presentation and very insightful. First of all, I would like to ask, what do you think will be the emerging technology that will be more in the real estate sector and in the prompt tech, in particular in the region in the future, if you think that there will be mega trend except the AI? And also for both Thomas and Mark, if just a piece of advice that you will give to a student or someone that would like to pursue your career in future.
Okay, so in our space, in travel or in hospitality, I think anything that reduces friction. I used that word just two seconds ago, but anything that reduces friction is going to overtake. So basically, anything that helps with speed and decision making, but is informative. So, for example, in our space in the accommodation, you can go on to booking.com and you can see every possible hotel pretty much, right? But actually our USP is that you can't book any more than normally 28, 29 nights on it. Whereas we're looking at our USP is longer term stays, right? So you've got to carve out something that is unique or is a little bit different, right? Now the technology thing is critical. When you say you've got an AI spin, AI is, as you can see, is taking over the world. It's taking people's jobs. It's everything. I think this one is going to be here to stay. It's just going to be what that AI can help you leverage. So it's going to just be what the next stage of AI is still going to be the next tech thing. In my space, I think taking away things like viewings and making sure that people can see exactly what they're getting straight away. So I love these kind of quick videos that people show. There's a couple of companies, a couple of startups that do it very, very well. So that type of thing. So anything that reduces friction using technology.
Fantastic, thank you, Mark. And
Thank you so much.
I think that's a great answer. I mean, certainly, I can't add much to the first piece. Just on your second point about the student thing, I would just say intern or get around entrepreneurs and investors. I think there's that line: you are the average of the 5 people you spend the most time with. And I think we've started popularizing that people should just become entrepreneurs rather than going to university or other things like that. I think that's a bit dangerous. Whether you go to university or not is obviously one choice, but I would just say think about an internship or think about working in an entrepreneurial company or think about working in an investment company, whether that's on an internship basis. I'm surprised how few it does. We do get approached with some, but if someone could propose a very specific, I would like to intern and do this, and this, and his grounded view of my experience as a student, I think we would consider it. I'll now get flooded with people doing that. But I just say, yeah, get around people like that, because I found, when I spend time with people who are 20 years ahead of from where I am now, I learned so much from them, and it massively accelerates my own learning and my experience. And I wish I'd done that more maybe 10, 15 years ago as well. So I hope that's useful.
Yeah, just from the founder side as well. Well, first of all, again, Thomas hit the nail on the head. You can learn so much from the younger generation, right? So they're often more on the ball than you are in terms of what's new. So we take in turns because, again, there's two reasons. So quite often they're obviously a cheaper way as a startup to get tasks done, but we also help them grow. So just to give you an idea, we've had two of our employees from Egypt. It's cheaper. We employ them in Egypt, etc., etc. We've grown one of the interns to become a full-time employee with us, and they're currently over in Dubai with us now for the next month because we see them strategically as important for us. So they've grown with us as well. So I think if you can learn from them and they can learn from you, I think that's a really good payback, even if they are, let's be realistic, a cheaper option for you at the time as a startup.
Fantastic. Thank you so much, Mark and Thomas, for the valuable knowledge that you've shared with us and your experience. What I think we'll do, I don't think there's any more questions on the chat. Let's try and wrap this up now. Thank you everyone for joining. It's been valuable to me, and I'm sure it's been valuable to you as well. If you've got any more questions or you want to follow up with Kent Consulting, you can use the link on the presentation. It'll also be available in the chat as well. If you want to connect to any of the groups, the Gulf Investors Group, please let us know, and we'll get you set up there as well. If you have any more questions for Mark and Thomas, we'll look into try and get those answered. But obviously, Mark and Thomas both have full-time jobs, so we can't spend the rest of their lives answering questions for us. But we may have a select few. If there's any points worth raising, we'll share with everyone. Okay. Thank you all for joining, and thank you so much for a fabulous webinar. Thank you.
Thank you so much.
Thank you for having us.
Thank you very much.
Thanks, everyone.
Thank you, guys. Bye-bye.
Bye.
Bye.